Good afternoon, everyone, and welcome to the Aviance Capital Partners quarterly conference call and webinar. My name is Matthew Johnson, and I'll be moderating today's call. We'll be discussing the current market environment and the Aviance Capital Partners economic outlook. Today's panelists are Jim Neal, Chartered Financial Analyst and founding member of Aviance Capital Partners, and Jack Brown, Chartered Financial Analyst and Chief Investment Officer of Aviance Capital Partners. On your screen, you'll see a dialog box where you can ask any questions. Please feel free to type them in as they come to you, and they'll be answered by the panelists following the presentation. Today's overview, we'd like to look at U.S. Treasury yields, market and economic outlook, the U.S. economy, warning signs and bright spots, some market highlights, the summary, and the interactive question and answering. I'd like to start today's call with commentary from Jim Neal. Jim?
Yes, thank you, Matt, and welcome to all of you. Thank you for joining us today. I put this table together 2 days ago, and it's changed already. What I wanted to show, it's the 2-year Treasury, the 10-year Treasury, and the 30-year Treasury, and my intent was to show you how interest rates have come down over the past year, year to date, and quarter to date. We showed 158 on the 2-year, 165 on the 10, and 214 on the 30-year. And as you can see, they're all down significantly from where they were a year ago. Well, today the stock market was in turmoil, down, I think, at the end about 800 points. And the conversation all day has been the fact that the yield curve inverted. And the inversion was between the 2-year and the 10-year. The inversion means that the 2-year was yielding more than the 10-year. In fact, it moved back and forth during the day. And if I had this table to print right now, we would show the 2-year unchanged at 158. We would show the 10-year at 159, down, 6 basis points. And we would show the 30-year at 2.03, down 11 basis points. And these are significant numbers. Interest rates across the board are low. They have all come down in the past year. We can discuss for an hour and a half or more as to the conditions and reasons why. But I think there's some important information what happened today. Historically, when the 2 and 10-year invert, it can be an indication that a recession is coming. Well, no matter where you stand in a cycle, you can always say a recession is coming. It may be 3 or 4 years down the road, but it is coming. Just as night follows day. But when the 2 invert, it is a sign that is considered typically a warning sign, and the stock market responded negatively. There are a couple points I'd like to make before I turn it over to Jack. Number one is that the yield curve, an inversion does precede a recession, but an inversion does not necessarily mean a recession is coming quickly. In fact, somebody once said that the inverted yield curve has indicated or suggested 10 of the past 5 recessions. Think about those numbers. And the other thing I would say, which I believe is really important, is the way this inverted. Traditionally, it inverts because the Fed is raising short-term interest rates to cool off an overheated economy, and the short-term rate, or the 2-year rate, moves higher, moves up faster than the 10-year, and that's what causes the inversion. This is the complete opposite. Here we have where the 10-year rate has come down and the 2-year rate has come down. The fact is that the 10-year rate came down more than the 2-year. We were only, 17 points away from, or so, 27 points away from an inversion last year, and here we are. We've inverted, and it's caused havoc. This has yet to play itself completely out, and I think, as Jack will say, there are reasons to be concerned, but there are also reasons to be optimistic. And so, at that, I'm going to let you look at this table. You have it. If you have further questions on it, please ask them or contact Matthew later, and we'll try to get an answer back to you on an email. And so, Jack, it's all yours at this point.
All right. Thank you, Jim. Appreciate the overview, and that's actually a good lead-in to the first slide that I have. The bottom line with our view of the economy is that we think it's going to continue to grow. We don't see a recession in the immediate future. There's definitely some warning signs, and so the days like today in the stock market, it always kind of leads to a spark. Hey, should we be concerned here? And certainly there are things to look at that say that make sure the risks aren't too great, that sort of thing. This first chart is interesting. It's the copper to gold ratio. That's the purple line, and that shows us that when copper prices go down relative to gold prices, so do interest rates, and vice versa. So what this is saying is that the expectations about economic growth are somewhat tied to long-term interest rates. So when the copper price goes down, as it has pretty much all year relative to gold, it's saying these important input prices, these import factors of production, the enthusiasm behind buying those has trailed off a little bit because some of the enthusiasm about the growth potential has trailed off. And so you see this decline in ratio a bit. And so that, as you'll see, syncs up pretty decently to the 10-year Treasury yield, which is a pretty good approximation for long-term rates. And there's a theory that long-term rates are pretty much tied to longer-term growth expectations in the economy. So the warning sign here is that long-term expectations have come down. And as Jim has noted, the long-term rates have come down further than the short-term rates. So it's one of those things that doesn't necessarily mean a recession's coming, but it's something we have to factor in as expectations are rather important over time. So let's jump to the next slide. So what happens when rates become very low? Well, it becomes pretty attractive to borrow money. So what this slide is showing us is that corporations have started to borrow quite a bit of money. And the blue line is specifically showing us the level of corporate debt, the level of overall corporate debt and loans, liabilities, if you will, relative to the size of the U.S. economy. On the far right is where we are today, and what this is showing us is that the amount of corporate debt out there is higher than previous peaks. So we're at pretty high levels right now. The warning sign, or the thing to pay attention to, is right when you hit these peaks, these borrowing peaks in the corporate debt cycle, that tends to coincide with economic peaks as well. So because we're at these high levels, it kind of looks like, just visually looking at the chart, that there's might be some risk that we're close to some sort of economic peak, and then of course a recession would follow. So that's the warning sign. How do we know if we should really be concerned? Typically what happens in the corporate debt market, for example, is that people start selling. People want to get rid of their corporate bonds. So you see prices go down, and corresponding to that, you see the yields on corporate debt go up. So this green line shows us these spikes. And whenever you see one of those spikes, it's indicative of corporate bond, people selling off. And so what you'll notice on the far right side of the slide, you see a little bit of volatility there, but it's really not enough to get us concerned. In fact, I think most people would agree that the corporate bond market and the overall bond market is pretty well behaved right now. So there's not a tremendous amount of concern there, and certainly a good part of the debt level has to do with very low interest rates that we're seeing. So next slide, please. This is an interesting chart. I'll do my best to explain it. I think it tells a rather interesting story. One thing we say quite a bit is that over the long run, businesses tend to grow at about the same rate as the U.S. economy, total economic growth. And what this chart is showing you is kind of the growth rate of corporate profits in the green line versus the growth rate of the U.S. economy, which is the blue line. And you'll see that over the long run, they kind of go back and forth relative to one another. The green line, of course, being much more volatile, that's corporate profits. But what this is showing us is a couple things. If you look back in the mid-90s, somewhere on the right half of this chart, you'll see the green line kind of come in a little bit. That was when we were leading up to the internet bubble. We were investing a lot in new technologies and that sort of thing. And then we had the internet bubble that crashed. But what came out of that, from the rubble of that crash, came some very big technology companies that are wildly successful. And you have these profit margins, like the 4 or 5 biggest companies out there. Four out of the 5 biggest companies, I should say, are tech companies, and they're generating profit margins of in the 30% range. So we're seeing a lot of profits coming from that, and so with that, you see overall corporate profit kind of have blossomed. If you look at the far right of the chart, you'll see that the green line is kind of wiggling its way sideways and actually coming down a little bit. This is showing us that overall level of corporate profits are also going sideways. Or, the concern might be that profit margins may be flattening and coming in a little bit. It's just one of those areas we want to keep an eye on. So that's a warning sign when we're looking at the overall market, if you will. But it factors into certainly the overall economy and how businesses fit into it as well. So let's look at the next slide, please. All right, so if we switch gears to the consumer, the warning signs here, I think, are rather mild, quite frankly. And I say this because when you look at the overwhelming body of evidence, the consumer is doing really good. But we do want to look at a variety of concepts that are going on here. One of it is consumer debt and liabilities. The orange line is representative of U.S. mortgages. That is the biggest segment of consumer liabilities. That's doing very well. People have been rather conservative since the 2008 timeframe, and the delinquencies there are rather low. Everyone's paying their mortgages on time. The overall level of debt is actually shrinking relative to things like income and that sort of thing. But there are certain segments of the consumer liability markets where we're seeing slightly higher levels of delinquency rates, and they're growing a little bit too, the delinquency rates. So areas like like credit cards and autos, for example, we're seeing delinquency rates pick up a little bit. You hear a lot about student loans. Well, those have the highest delinquency rates. That picked up around 2012 and it's kind of been hovering in that area. So nothing terribly significant here, but it's an area we just kind of keeping an eye on. It's a warning sign. It's one of those things you want to kind of track as we move along. So next slide, please. That pretty much sums up the major warning signs. There are other things we could certainly discuss, like the global economy. There's a slowdown in Germany. That was kind of a big news item today. We could certainly dive into that topic a little bit more. But if we're zeroing in on what's happening here, the bright spots still dominate, and that's kind of where I wanted to highlight some of the bright spots. So with that, let's jump to the next slide. If you look at the leading indicators, and there's a lot of different leading indicators out there. This is one of the Federal Reserve's, this is their leading indicator index, and you put together some of the big important things like wages and spending and construction and certain interest rate measurements. But when you put these together, what we're looking at is leading indicators that are still telling us the economy is in pretty good shape. This is the type of indicator that you'll see it roll over, typically going into a recession. It looks pretty solid if you look at it right now. So this is an important bogey. It's showing us that we're doing pretty good right now. Next slide, please. When we think about the consumer or the household, which is essentially the same thing, that's where the bulk of economic activity happens. About 2/3 of economic activity comes from consumer spending. So it's good to understand how well the consumer is doing. We did see that there are some delinquency rates rising in certain areas like credit cards and autos, But overall, when we look at the household and we look at the amount of liabilities out there relative to the size of the economy, it's actually come down quite a bit. If you recall back in the 2008 time period, there was a lot of news items out there and a lot of discussions and emails going back and forth. And wow, the consumer's got so much debt. The consumer debt's the same size as the economy, and that was a very scary thing. And it quite frankly became a big risk and a problem. But since then, consumer debt's come down from about 100% of the economy to around 75% where it is today, roughly in line where we were in the late 90s, early 2000 time frame. This is a good thing. It basically means that the consumer, the household's in much better shape than it was. It's overall conservative. And so this is certainly a bright spot, an important bright spot in the economy. Next slide, please. Going back to the concept of corporate bonds, the nice thing about corporate bonds is they kind of give a good reflection not only about what's going on in the corporate bond world, but they're somewhat linked to the stock market. Their price behavior is, but it also people tend to sell corporate bonds leading into recession. So there's kind of this nice area to study if you want to kind of get a sense of what's going on in the larger world and potentially for the markets. What this chart is showing us is it's relating corporate bond yields relative to the growth of the U.S. economy. So it's that simple metric. But what you'll notice is that the blue line spikes leading into recession, and that's simply saying that corporate bond yields are going up more so than the growth of the economy, and it's saying people are selling corporate bonds, and so what you'll see here is a really good correlation between what happens there and with what happens with recessions. The reason this is a bright spot is kind of what we alluded to earlier, but basically there's not a lot of selling. There's a lot of continued confidence in that area. It is an area where we kind of want to keep a pretty close eye on because there's warning signs there, but so far it's been a very well behaved area. So we're keeping an eye on that. Next slide, please. Okay, so this is relevant also to today and also relevant to Jim's discussion about the yield curve. This is a different way of looking at both the yield curve and employment. And I'll start with the yield curve for this discussion. That's the red line. The idea that long-term rates could be lower than short-term rates. When that happens, that's a negative yield curve. On this graphic, you'll see that the red line dips below zero, dips below that dark black line. That is a negative yield curve when you're looking at the 10-year and the 2-year. So that's what basically they're saying, and this is what it looks like when the yield curve goes negative, and then you see one of those gray bars, which represents an official recession, and that's what the concern is. Basically today is that negative yield curve is a big concern. Germany was the other concern, but basically it was a rough day in the market is reflective of what I think the yield curve was really the bigger story. So that's a concern, but one of those, it's, as Jim also said, a negative yield curve predicts more recessions than actually happen. So it's kind of it's an overexcited metric, if you will. Right now it's saying, hey, well, we might be getting a recession. What you would typically want to see to confirm that is you'd want to see other areas to say, hey, there's some warning signs too. The blue line, which is the other line, talks about the employment situation. It's telling us about that. It's essentially the workforce participation rate. And it's the change to that rate over time. And basically what happens before a recession, you see the blue line kind of careens over into negative. And that's showing us that the workforce participation rate is shrinking. So if you follow that line, it happens pretty systematically heading into recessions. Where we are today is that the employment situation looks good. There's a lot of different metrics and statistics out there that'll confirm that. This is one of them. It's saying that the bulk of the U.S. economy is made up of consumers. Consumers are gainfully employed. Wages are rising. There's not a real fire drill here, if you will. So that's a really important counter to the idea that the yield curve is negative, from my opinion. Let's flip to the next slide. Okay, we're going to talk a little bit about market highlights. The valuation for the market. It's not really highly debated right now. I think some people are saying, well, we just don't like the PE ratio, it's high. That may be the case. The way we look at it, the market is probably fairly valued right now. How do we get there? Well, first of all, I'll explain the purple line. The purple line is basically the price-earning ratio for the market. We use the cyclically adjusted earnings, so price to cyclically adjusted earnings is the purple line. That shows us, you can see that big internet bubble we had in the late 90s, and then you can see all the other actions since then. The green line is our internal metric we use to determine what we think the PE ratio should be for the market, and it's basically a function of corporate bond yields and treasury bond yields. And what's happening right now is that corporate bond yields are actually pretty close to treasury bond yields relative to its own history. So as I mentioned earlier, the corporate bond market is pretty well behaved. It's trading yield-wise, trading pretty close to treasuries, which means there's a lot of confidence there, and treasury yields are low. When you put those factors together, it kind of leads to higher risk-taking and higher PE ratios and things like that. So we're comfortable with the valuation of the market right now. In other words, we don't think there's a bubble. Next slide, please. This is the last slide. This area has been getting a bit of coverage lately. It's an interesting discussion for us because we manage both a value investing style and a growth investing style. Both of our approaches have done pretty well relative to their benchmarks and things like that. But what I'll say, it's interesting because sometimes value investing does really well, and sometimes growth investing does really well. If you're simply looking at the value index relative to the growth index, and you're just running that ratio of those two things over time, you get this blue line that we see in this chart. And when the blue line goes down, it simply means that growth investing is doing better than value investing. And you'll notice that the blue line has basically been going down since about 2006 for about the past 13 years. And we kind of recognize that. And it kind of goes back a little bit to what we were talking about earlier. With coming out of the internet bubble collapse came some wonderful, large, humongously profitable tech companies. And so those are squarely in the growth space, and these expanding profit margins, lots of money. So that the technology space went from kind of a regular size sector, and now it's the largest sector, whether you're looking at market capitalization, profit margins, things like that, overall level of profits. And that's kind of been the story for the past 13 years is kind of a, the proof of that concept working into its place. But it's been difficult if you're a value investor to keep up, if you will, relative to the growth approach. But there's a lot of different things that are showing us that, maybe things are closer to on par. This chart kind of shows you that prices are back to where they were in that mid-1990s timeframe. So that's one way of looking at it. You could look at other metrics like the PE ratio of growth stocks to the PE ratio of value stocks. And they used to be much closer together, and now they're kind of separated. So value stocks look cheap and growth stocks look about where they're supposed to look. And so there's other different areas, but it's been an interesting story that's been developing, and it's something that we are keenly interested in as well. With that, we'll summarize things. Today was an example in the stock market that there are definitely warning signs. The market is reacting to that. Corporate debt levels is kind of a big theme of in today's presentation. They're high. Corporate debt levels are high. We want to keep an eye on that. So that's certainly one warning sign. Growth expectations. We're looking at copper prices and things like that, and lower long-term interest rates. that's showing us that expectations have come down. They've been coming down pretty much all year. We have to be a little bit concerned about concepts like a self-fulfilling prophecy. I don't know how well proven that is in the world of economics, but it's certainly an important concept. We're looking at profit margins that they're still big. Profit margins are still really good, but they seem to be normalizing quite a bit. So we're looking at margin growth and corporate profit growth and things like that as something to keep an eye on. Bright spots, the overwhelming body of evidence, and these are the big important indicators, are still very robust. So those are still dominating, leading us to the conclusion that there's probably going to be no recession in the near future. And without a recession, the market tends to do pretty well. So that's kind of where we land right now with everything going on. And when we look specifically at the market, we don't see it as overvalued. We see it as expensive, but not overvalued. And there seems to be a lot more parity when you're looking at different areas of the market based on past performance and valuation levels and things like that. So that's my summary, Matt. I'll pass it back to you.
Perfect. Thank you, Jack. I appreciate the insight. That concludes our prepared portion of the presentation. I'd like to take this time to answer some of the questions that have come in. If you still have time to post some questions in the dialogue box there, but I'll start with the questions that have previously been posted. First question, how do you generate investment income in a low interest rate environment?
There's certainly different ways of doing that. One of our strategies focuses specifically on that concept, and so different environments yield different results and different income levels. And right now we have this low interest rate environment. We've kind of had a low interest rate environment for some time, but what is happening now with our particular strategy, for example, we have at least half of the strategy, over half of the strategy is tied to equity securities. And if you think about what's going on in the equity space, we still get these big profit margins and we still get attractive valuations with a lot of different equities. So you're able to find really good high dividend yielding areas and equity related securities that produce attractive distribution. So that's one area. We're also, I think there's different fund structures. We're able to find some advantage in areas like closed-end funds and things like that, where you get these attractive managed distribution policies. And overall, it can be difficult. So you need to zero in on the stability of the dividends and other fundamental areas of research to cover. But those are kind of two of the key ways that we have found higher levels of income in this particular environment.
Perfect. Thank you. The next question, with negative interest rates in Europe and the U.S. yield curve now somewhat inverted, does this imply a global slowdown is now underway, or are we headed towards deflation?
I'll give my thoughts, and Jim, if you have anything, please add it. Feel free to jump in. There's a tremendous amount of debt issued out there, but there's also a tremendous amount of interest in holding debt. And I think, it really gets down to a supply-demand situation. But if you look at big economies like Germany, they are very dependent on exports. And that's kind of led them to maybe a pullback in their economic situation right now. And so, people are comfortable with buying low, basically negative yielding securities, and it's still far from ideal, but that's leading to investors buying U.S. securities that are trading at very low levels as well. It's just kind of, everything kind of reaches parity, and so we're kind of feeling the brunt of that. Doesn't necessarily mean we'll be in an environment that the economy has to shrink. So low interest rates are here. It's an unwritten story, but we're certainly in the middle of it.
I would add, I do not believe that we're headed towards deflation.
Perfect. Thank you, Jim. Next question, is it advisable to add gold to the portfolio at this time?
I think there's nothing wrong with owning a portion of gold. Gold doesn't appear to be particularly overvalued or undervalued. I think it looked kind of overvalued from my perspective a few years ago. But it's really, it's one of those areas when you can put your money in cash and generate decent money market rates of return and basically keep up with inflation, that's when cash seems to make sense. And if you can't do that, we had this interest rate environment where the Federal Reserve was keeping rates artificially low for a while. When rates are held lower than inflation for a period of time, gold looks particularly good. We right now the Federal Reserve has interest rates pretty close to inflation, so it's kind of a toss up. Hard to say which way we'll be headed next in terms of gold pricing, but it's a great diversifier as well. I don't look at it as a huge opportunity, but maybe if you feel it's important to put a portion of your assets, could certainly go in gold.
Perfect. Thank you. Next question. It's my understanding that stock buybacks have supported this market run-up over the past few years. With long-term interest rates falling, is it possible that corporations would be incentivized to borrow funds to buy back additional stock, thus pushing the market higher?
Yeah, certainly in a low interest rate environment, I think if you were running a company and you could say I could go out and borrow money for 10 years at basically a very, very low level of interest, that would make a lot of sense. It's certainly cheaper than issuing stock and diluting yourself. So I think there's a huge market incentive for companies to borrow money. What they do with those funds, the hope is, and one of the things we do is when we look for companies to invest in, are they using that money wisely? Are they using their capital wisely? And sometimes that makes a tremendous amount of sense, and sometimes it doesn't on a case-by-case basis. But the low interest rate environment does provide that incentive for companies to borrow money, and a good percentage of them will be buying back stock. So I think that would certainly, that's been a support to the market, and I think it will continue to be a support to the market at these low levels.
I'd like to add that I agree with Jack, and one other thought about the low interest rate environment. If a portfolio has existing bonds, we should always check the call dates, because in this environment, bonds that are callable within the next year or so are probably likely very much to be called, because the companies can reissue the bonds at lower rates than they're currently paying. So we'll probably see a pickup in that activity.
Thank you, Jim. Last question I have in the queue here is, could you summarize your thoughts on inflation? I know we've talked about it throughout the presentation, but could you summarize your thoughts on inflation in general?
I'll give you my thoughts, and then Jack can add his in. I think inflation has largely not been an issue in here. The Fed has been targeting a 2% inflation rate, and by their own measurements, it's coming in around 1.5%. I think for the foreseeable future, inflation and deflation is not likely to be a problem in here. If anything, I would expect over the next year or two that inflation would work its way higher, but at this point, the evidence does not suggest when it's going to happen. Jack, if you have anything?
I do. I would say that if you look at the borrowing activity, we're still seeing lower levels of borrowing activity among consumers. Consumers are still being rather conservative, And one of the ways of looking at potential inflation is kind of money velocity and the idea of what's happening with the growth rate of money and how fastly that's being used. And the borrowing and lending cycle is telling us that, you know, the bulk of the people that borrow out there, the average consumer is still being kind of conservative. So that's saying that that we don't have a lot of inflation right now. Another thing that could cause inflation, and this is kind of on the other hand, is trade activity. Who knows what's going to happen with the trade negotiations with China and other areas? If we have an extended trade war, that will probably lead to some price pressures in some areas. So I think there's some potential there, but I just am skeptical that we're going to have a long, extended trade war that would lead to inflation. So I think on balance, it's going to remain relatively calm. If the economy does heat up quite a bit, that would catch a lot of people off guard, and I think that would lead to inflation as well. There's always potential for that to happen. So,
Okay. On that same vein, there's another question that had come in. How likely are China and the U.S. to resolve this trade dispute with, how likely are China and U.S. To resolve this trade dispute?
that's a tough one. That gets into geopolitical areas, and my personal view is that both sides will eventually want to reach some kind of resolution, and I'm kind of the view that it'll continue for some time. We did see, you know, the idea to delay the tariffs until January, I think, was an interesting move on our side. But I think there will be some kind of resolution. Probably. It's hard to say if they want to do it before or after the election. There's a part of me thinks that the idea of an ongoing trade struggle might be a political move that is actually being done on purpose. So it's hard to really say. But I think it will be resolved in the next couple of years.
I had one thought. Agree with Jack. I think the Hong Kong situation is very difficult. If the Chinese move their army into Hong Kong itself, I think it probably will create a very negative reaction worldwide and probably make a trade deal politically impossible in the near or even in the intermediate term. So I think watching what happens in Hong Kong is very important. Police, fine, those are Hong Kong police, but if they move the People's Liberation Army in, then I think it's a new ballgame.
Thank you. Well, I would like to thank today's panelists for their insight and welcome you to contact us with any comments or on today's presentation or with any account-specific questions. We thank you, the panelists, for their time and the rest of the audience for their time as well, and we look forward to speaking with you soon. That concludes today's presentation. Thank you.